Picture this. Oil can sit under sand in Saudi Arabia, or under rock in Texas, or under water off Brazil. But to move that oil across the planet, the world still reaches for the same green paper, the U.S. dollar. Not because America invented oil, because for half a century, the price of energy and the plumbing of global money got welded together. And once that weld cooled, almost every country on Earth had to hold dollars just to keep the lights on. That quiet force has a name, the petrodollar. And once you see how it works, a lot of confusing headlines suddenly make sense. Most people hear petrodollar and think it is some secret treaty locked in a vault. Hold that thought. The real story is stranger and more powerful than the internet version. It starts not in a desert, but in a New Hampshire hotel in 1944. Near the end of World War II, 44 countries met at Bretton Woods. They needed a money system for a broken world. The deal they built was simple on paper. Other currencies would peg to the U.S. dollar, and the dollar would be convertible into gold at $35 an ounce for foreign governments. America held about 3/4 of the world's official gold at the system's birth, according to Federal Reserve histories. So the dollar became the world's reserve currency almost by design. For a while, it worked. Europe and Japan rebuilt. They needed dollars to buy American goods. Global trade used the dollar as the trusted middleman. Then the math turned ugly. The United States spent heavily at home and abroad. Dollars piled up overseas faster than gold could back them. Economists later named the trap the Triffin dilemma. The world needed more dollars for trade, but creating more dollars slowly undermined trust in the gold promise. More claims on gold, the same limited metal. Something had to give. By 1971, that tension snapped. From August 13th to 15th, Nixon and top advisors met at Camp David. On the evening of August 15th, the president went on television. He suspended the dollar's convertibility into gold. Foreign governments could no longer walk up and demand metal for their paper. Historians call it the Nixon Shock. Overnight, the post-war gold link was gone. The dollar became a fiat currency, backed by U.S. credit, laws, and markets, not by an official gold window. A later attempt, the Smithsonian Agreement, tried to patch fixed rates. By March 1973, major currencies moved into floating exchange rates. The Bretton Woods cage was finished. Here's the part that still feels wild. The dollar did not collapse when gold left the room. Instead, the world searched for a new kind of anchor. Not a metal this time, a commodity every industrial country had to buy: oil. Fast forward 2 years, October 1973. After the Yom Kippur War, Arab oil producers launched an embargo against the United States and several allies. Production cuts hit the market hard. According to Federal Reserve histories, oil that had traded near roughly $3 a barrel raced toward nearly $12 by early 1974. That's about a 4-fold jump. Gas lines snaked through American neighborhoods. Drivers sat for hours and wondered what happened to normal life. Inflation bit harder. Suddenly, energy was not just a price on a chart. It was a political weapon and a money story. Oil exporters were collecting enormous dollar revenues. Importers were desperate for fuel. And Washington was looking at a world where the old gold promise was dead, yet the dollar still sat at the center of trade. That's the hinge of the petrodollar era. In June 1974, the United States and Saudi Arabia publicly signed a broad joint framework for economic and security cooperation. Official records describe joint commissions on economic development and military needs. Treasury Secretary William Simon traveled the region seeking places for surplus oil money to land. Reporting from the period and later historical accounts describe a practical pattern that took hold. Oil sales kept being priced and settled in dollars. Surplus revenues were recycled into U.S. financial assets, including treasuries, and into Western banks.
Military and economic ties between Washington and Riyadh deepened. Careful language matters here. There was no publicly released magic treaty that said, forever, every barrel must be sold only in dollars. What historians and contemporary reporting describe is a web of arrangements, incentives, and market habits. Oil was already often priced in dollars. The 1970s made that habit stick and then scale. Other OPEC producers followed the dollar pricing practice. And once the world's most important commodity traded in dollars, something mechanical happened. Japan needed dollars to buy oil. India needed dollars to buy oil. South Korea needed dollars to buy oil. Even countries that never traded with America still needed greenbacks for energy. Central banks began holding more dollars as insurance, not for patriotism, for survival. Here's how petrodollar recycling works in plain English. Country A sells oil. Buyer pays in dollars. Country A now holds more dollars than it can spend at home right away, so it parks those dollars somewhere safe and liquid. Often that means U.S. Treasury securities or deposits in big international banks. Those banks then lend the money onward to countries that need dollars to import oil, machines, and goods. In the 1970s, that lending helped oil importers stay solvent after prices exploded. Oil dollars leave the oil well, circle through banks and bond markets, and come back as loans and investments. That loop is recycling. It helped finance American deficits. It deepened dollar markets, and it made the dollar feel like the only language global energy understood.
There is another piece most videos skip, the Eurodollar system. Eurodollars are simply U.S. dollars held in banks outside the United States, historically centered in London. They are not euros, they are offshore dollars. In the 1970s, oil money poured into that offshore dollar market. Banks in Europe could take OPEC deposits and lend dollar credit around the world without every transaction touching a U.S. retail branch. That made the dollar not just America's money, but the planet's working capital. Even today, huge volumes of dollar credit live outside U.S. borders. That is why a rate decision in Washington can rattle borrowers from Istanbul to Sao Paulo. Pause for a second. If you felt that click in your chest when the pieces lined up, you are not alone. This is the moment money stops looking like paper and starts looking like architecture. So why does almost every country still need dollars? 3 practical reasons. First, commodities and trade. Oil and many other goods are still widely invoiced in dollars, especially outside Europe. Federal Reserve research has long shown the dollar's share of trade invoices far exceeds America's share of world trade. In the Americas, dollar invoicing has been near total. Across much of Asia and the rest of the world, it has also been dominant, while Europe leans more on the euro. Second, debt. A huge slice of international borrowing is written in dollars. If your loans are in dollars, you need dollars to service them, even if your local shops take pesos or rupees. Third, reserves. Central banks hold dollars because everyone else accepts them. Liquidity begets liquidity. That network effect is the quiet king. Does that mean nothing ever changes? No. The euro became a serious rival in European trade. China has pushed yuan settlement in parts of its oil and commodity business. BRICS countries talk about local currency trade and new payment rails. Some energy deals settle outside the dollar by design. Sanctioned economies have also searched for workarounds. Those headlines are real. They are also easy to oversell. A few bilateral deals do not erase a 50-year network overnight. As of recent IMF COFER data for the first quarter of 2026, the U.S. dollar still made up about 57% of global foreign exchange reserves. The euro was near 20%, the Chinese renminbi was near 2%. An IMF payment study using SWIFT data for 2024 still put the dollar first in cross-border messaging flows, above half of measured customer and financial institution payments. Fed notes also show the dollar remaining central in FX trading and international finance. In other words, the map is getting more multipolar at the edges. The core plumbing is still dollar-heavy. Here's the unique angle most channels miss. In 2024, a viral claim said a 50-year secret petrodollar treaty with Saudi Arabia had expired and oil would ditch the dollar overnight.
Fact-checkers at outlets like PolitiFact and AFP found no evidence of such a formal 50-year oil pricing treaty ending that way. What existed in 1974 was a public cooperation framework and, according to historians and period reporting, informal financial recycling practices. A government audit of the Joint Economic Commission described cooperation and recycling goals, not a public clause forcing exclusive dollar oil sales forever. Oil keeps trading in dollars mainly because markets, contracts, and banking networks still prefer the deepest, most usable currency. The myth makes a great thumbnail. The mechanism is more boring and more durable. Habit plus liquidity plus debt plus oil pricing practice. That combination is harder to kill with a single announcement. Think about what that means for ordinary life. When oil spikes, your grocery bill can follow. When the dollar strengthens, emerging markets can feel a squeeze on their dollar debts. When treasury markets stay deep, global savings have a parking lot. The petrodollar story is not only about deserts and presidents, it's about why a factory in Malaysia, a shipping firm in Greece, and a pension fund in Norway all keep a line open to the same currency. Wait, that sounds abstract until your own costs move. Then it's personal. So the full arc looks like this. Bretton Woods made the dollar the gold-linked reserve. Nixon cut the gold cord in 1971. The oil shocks of the 1970s turned energy into the new gravitational pull. Reported U.S. Saudi economic and security ties plus OPEC dollar pricing practice locked the habit in. Recycling and Eurodollars spread dollar credit worldwide. Decades later, rivals chip at the edges, yet reserves, invoices, and payments still show a system built around the greenback. If you only remember one sentence, remember this: the world does not need dollars because a slogan says so. The world needs dollars because oil, debt, and banking networks all learn to speak dollar, and switching languages at global scale is slow, expensive, and risky. That's power without fireworks, quiet, structural, hard to unwind. One more layer is still left beneath this money map, a quieter force that decides who gets to borrow cheaply and who pays the price when the system tightens. Thanks for watching. If you want to see more videos like this, make sure to like this video and subscribe to the channel.